Buying on margin? Have you heard this term before? It's a strategy that can multiply your profits, but it can also wipe out your account. I'm Chad with Zero Markets, and in this video, I'll show you how margin buying actually works, what the advantages are, and the risks of using this tool in the financial markets. The idea is simple. You borrow money from your broker to buy more assets than you could with just your own balance. It's like boosting your purchase power with leverage. The problem is this is a double-edged sword. It can magnify your profits, but also your losses. Let's break down exactly how margin buying works. Basically, you deposit an initial amount into your margin account, and with that as collateral, the broker lends you money to buy more assets. For example, you can put down 10% and finance the other 90% with the loan. Still confused? All right, let's take a look at another example. Imagine you want to buy 100 shares at $100 each, a total of $10,000, but you only have $5,000. By buying on margin, you use your $5,000 and borrow another $5,000 from the broker. If the stock doubles to 200, you sell for $20,000, pay back the $5,000, and keep $15,000. Result? You just tripled your initial investment. But if the stock falls 50% to $50, you sell for $5,000, pay back the $5,000 loan, and end up with nothing. A total loss of 100%. Sounds incredible, right? But there's more you need to know. Here's what you need to understand about margin requirements. Each broker sets the initial margin, the minimum you must invest, and the maintenance margin, the minimum balance required. Let's go through the steps. Open a margin account. Unlike a standard account, it lets you borrow against assets you already own. Deposit initial funds. Here at Zero Markets, you can start with as little as $5. Buy assets with leverage. Use borrowed money to increase your exposure. Monitor constantly. If your assets drop and your balance falls below the maintenance margin, you may face a margin call. Either deposit more funds or the broker will sell your assets to cover the shortfall. Okay, now who would use this strategy? Buying on margin is recommended only for experienced investors who understand the risks and have the discipline to manage positions. For beginners, leverage is dangerous since losses can exceed your initial investment. So be careful. Speed can be dangerous, right? Let me break down the risks and advantages very clearly. The advantages of buying on margin: allows larger trades without needing all the capital up front, amplifies potential returns, provides flexibility, letting you hold existing assets while pursuing new opportunities. The risks of buying on margin: you can lose more than you invested. You'll pay interest and extra fees. You can be forced into selling in margin calls, often at unfavorable times. Buying on margin can be a powerful tool to boost your gains, but it demands caution and preparation. It's like driving a sports car. It can be thrilling, but without control, a crash is inevitable. If you want to use margin, study carefully, start small, and never forget that risk grows at the same pace as opportunity. If this video helped you better understand how margin buying works, hit subscribe to the Zero Markets channel and keep learning how to invest with awareness and strategy. And feel free to leave us your questions in the comments. Our experts will be glad to help you out.